If the economy slows down tomorrow, most people will do what feels safe. They'll hold cash, wait, and hope for clarity. But here's the problem. By the time things feel safe again, the biggest opportunities are already gone. There's a pattern you see in every major downturn, not in predictions, not in headlines, but in capital flows. Because money doesn't disappear in a crisis, it reallocates, quietly, systematically, and usually before the narrative changes. And if you track those flows historically, 2000, 2008, 2020, you'll notice something interesting. The assets that outperform during uncertainty are almost never the ones people chase during growth. Not because they're better, but because they behave differently under stress. So let's break down 4 of them, and more importantly, why most investors are structurally unable to own them when it matters. Most people think downturns are about timing. They're not. They're about positioning. Markets don't pause in a crisis. They reprice aggressively, and that creates 2 realities at the same time. Forced sellers, prepared buyers, same market, same prices, completely different outcomes. And the difference? Usually decided months or years before the crisis begins. Gold isn't a growth asset. It's a confidence hedge, and that distinction matters. Historically, gold tends to outperform when real interest rates fall. Currency stability is questioned. Central banks increase intervention. You saw this in 2008. You saw it again in 2020. And when confidence is high, gold often lags behind because capital moves toward growth. Stocks thrive on optimism. Gold thrives on uncertainty. So when fear rises, gold doesn't chase returns. It preserves trust. Gold doesn't produce cash flow. It doesn't innovate. It doesn't scale. But it has one critical feature. It doesn't rely on counterparty risk. And in a system built on promises, that becomes extremely valuable when trust breaks down. That's why gold can underperform for years and then suddenly reprice when nobody expects it. But protection alone doesn't build wealth. You also need cash flow resilience. That's where most portfolios quietly fail. They optimize for safety, but ignore sustainability. Because in the real world, expenses don't pause when markets do. Bills don't wait for a recovery. Cash flow gives you time, and time is what allows everything else to work. Cash flow under pressure. In a downturn, spending doesn't collapse. It reprioritizes. And that shift is usually predictable. Discretionary spending goes down. Essential spending stays stable. That's why assets tied to inelastic demand behave differently. Think farmland, energy infrastructure, water and utilities. These assets don't depend on optimism. They depend on necessity. And necessity is far more stable than sentiment. From a portfolio perspective, this changes the equation. You're not optimizing for maximum growth. You're optimizing for cash flow durability. Now we move from stability to where the real asymmetric returns can happen. Because asymmetry doesn't come from comfort. It comes from mispricing. Moments when risk is overestimated and opportunity is ignored. When capital retreats, but value remains intact. When headlines amplify fear and pricing disconnects from reality, that's where asymmetry lives. Not in certainty, but in the gap between perception and truth. When capital pulls back, but fundamentals don't break, that's where positioning matters most. Where mispricing lives. Every crisis creates forced decisions, and forced decisions create mispricing. This is where distressed credit comes in. Historically, some of the highest returns come from buying debt below intrinsic value, acquiring assets from liquidity-driven sellers, providing capital when nobody else can. During 2008, entire asset classes traded at massive discounts, not because they were worthless, but because liquidity disappeared. This is the key insight. Markets don't just misprice risk in crises. They misprice time. And investors who can extend their time horizon are the ones who capture that gap. But there's a catch. This strategy requires liquidity, expertise, emotional stability, which is exactly why most people never participate. And that leads to the most important asset of all, even though it doesn't look like one. Because the rarest advantage in investing isn't information, it's behavior. The ability to stay rational when everyone else is reacting, to hold position when volatility demands action, to wait when doing nothing feels like failure. Because in the end, discipline compounds, just like capital. Optionality is what turns a crisis into an opportunity. It's not about what you own. It's about what you're able to do. Optionality means liquidity, low fixed costs, minimal leverage, decision flexibility. Most investors fail here, not because they lack knowledge, but because they're fully allocated, income locked, expenses fixed, capital tied up. So when opportunities appear, they can't act. And in markets, the ability to act is greater than the ability to analyze. Because timing doesn't reward awareness, it rewards readiness. And readiness is built long before the opportunity appears. In quiet decisions, nobody notices. So when the window opens, you're not thinking, you're moving. Here's the real constraint in every downturn. It's not information. It's structure. You can understand everything we just discussed, agree with it completely, and still miss the opportunity. Because your system was built for stability, predictability, normal conditions, not for volatility. And systems don't adapt quickly under stress. People don't suddenly become flexible when their finances aren't. So instead of asking, which asset performs best in a crisis? Ask something more uncomfortable. Would I actually be able to act if prices dropped 30% tomorrow? Because when the next downturn hits, it won't feel like an opportunity. It will feel uncertain, risky, unclear. And most people won't hesitate because they're wrong. They'll hesitate because they're stuck. The investors who benefit most don't look smarter in the moment. They just built their system differently before it mattered. If you want to break down exactly how to build that system, what to remove, what to keep, and how to create real optionality, that's what we'll cover in the next video.